Well, welcome everybody. To start, it's my pleasure to acknowledge the country upon which we're joining the webinar today and to pay my respects to the elders of this land. I'm speaking to you all from the lands of the Wurundjeri people of the Kulin Nation. In our second EOA session of the year, today I'm pleased to introduce Shaun Cartoon from Arnold Bloch Leibler, who is going to give us a crash course in topical tax issues, the recurring but often overlooked tax issues. So Shaun is going to present to us today, and he's got a great presentation lined up. Through the session today, we have got the Q&A feature available. So please feed through your questions as we go, and then I will either interrupt Shaun to ask him those questions, or we can save some of them to the end. But definitely do use that Q&A feature. So without further ado, I will hand over to Shaun to get us started. Thank you.
Thanks very much, Michaela, and thanks everyone for joining in today. It's going to be a fantastic session. I've been thinking long and hard about how I would present a session on topical tax issues, understanding that not everyone is a tax nerd. I was looking down the list, and we have a great sample today of attendees from startups, private companies, advisors, trustees, listed companies. And so hopefully today there'll be something for everyone to take away. I think today it's a really interesting time in employee share schemes. One of the previous government's departing presence to share schemes practitioners were the great amendments that they made to the corporate regulatory environment, which will start on 1 October this year. And as we know, they also reformed got rid of tax on cessation of employment. But we also know that it doesn't stop there. Tax reform for employee share schemes is a continuing process, because we're always striving and want to strive to make the employee share schemes ecosystem more vibrant with greater participation. And so I think it's quite exciting, you know, with the new government now formed. It'll be interesting to see where they take employee share schemes in their term of government, with the support of groups like Employee Ownership Australia, which is a, you know, as a fantastic representative of the employee share schemes community. So today, the way today is going to work, it's going to be like, I've structured the presentation like speed dating for tax issues in share schemes. And so what I mean by that is I've come up with 20 points. Most of these are just interesting points that have come across my desk in recent times, which have made me pause and wonder what the issue is, because employee share schemes taxes, it's never straightforward. There are always different views and interpretations. So I'm hoping that as we go on the journey today, you'll learn something new. Please, I'd like this to be participatory. Fire your questions at me. Michaela will ask them of me, and we'll see how we go. So first up, I've got 8 points or 8 tax issues that I'd like to discuss around the startup tax concessions. Now, just as a quick refresher, these concessions, which came in 2015, are really a fantastic set of rules. They don't just apply to startups. There's no qualitative test for what a startup is. And really, if you work through the eligibility criteria, which I won't step through today, I'll take that as assumed knowledge, then really my view is that there isn't a better share scheme or option scheme than a startup qualifying plan, because really you're offering participants a plan with an elegant and simple design that gets them the CGT discounts, ideally. So, but there are a number of issues when it comes to applying the startup tax concessions, and I'm going to touch on a few of them this morning. And I might start with what I've called here market value issues, because this is probably the area where I spend the most time helping clients get their head around the different issues to do with market value and the critical importance of it, because if this requirement is not satisfied, then the concessions simply do not apply. And so this requirement broadly requires that if you're granting share options that are intended to qualify for the tax concessions, then the exercise price of the options cannot be less than the market value of a share in the company on the date of grant of the options. So when you start the discussion of market value, it's generally in an unlisted environment. It's, well, how long is a piece of string? Well, what is market value? And so generally, I focus on, well, have you raised capital from external, independent, arm's length third parties? If you have, then that's probably the best proxy for what your market value is. And then you say, okay, well, we did that 6 months ago or a year ago. Now what? And so generally I say, well, however close you are to your capital raising, that's better in terms of the strength of the argument that capital raising represents your market value. But also equally, if you did a capital raising 6 months ago and you say, well, not much has changed in the last 6 months, then I would still say that relying on that capital raising is probably still fair. But then it doesn't end there, because as we all know, startups have the benefit of access to a safe harbour valuation instrument that the ATO introduced shortly after these reforms came in 2015, and that's ESS 2015-1. Now, if the additional requirements in that legislative instrument, if they are satisfied, then the company can determine market value most commonly based on method 1 in that statement, which is based on net tangible assets. And as we all know, for a startup, if you can, as a proxy for market value, determine that value based on net tangible assets, then you're much more likely to get a very low market value, which is for the benefit of employees. And there's often this discussion where you say, okay, well, you can use net tangible assets and you can use what is really a low market value, but do you want to? And in my experience, a number of startups, they take comfort in knowing that there's a floor below which the exercise price cannot be set, but they do often still grant options with an exercise price above the NTA value. I've also seen an interesting issue where a startup group restructures. So we're not talking about one company here. We're talking suddenly about one or multiple companies in a group where there's a head company, and as a result of various rollovers, we then have a head company whose only asset is shares in its subsidiary company or companies. And then that invites the question, well, how do you apply the NTA methodology to a company that only has shares? Are shares tangible or intangible assets? Now, I'm not an accountant, but I have had various discussions with accountants, and I think the prevailing view is to treat shares as tangible assets. And then the question becomes, well, under the accounting rules, what value do you bring those shares into your accounts? And it might be book value or market value. And so that can influence your NTA calc. So I think it would be a very brave advisor to take a view that shares are not tangible assets, and so the NTA is nil. That clearly wouldn't be right. I'm also aware of a view of the ATO that's been expressed to me in the past that basically says that the value, really the intent of this is to capture the NTA on a group basis and to do it at subsidiary levels and in effect push up the NTA to the parent company, which is, it's an interesting view because the ESS 2015-1 is a very blunt instrument. It's not drafted with much sophistication. So I think there's quite a bit of reading into that instrument to reach that outcome. I might also just add here, today we're not talking about the regulatory reforms, but there is an important connection between ESS 2015-1 and the new regulatory reforms. And that is as follows. It's in new section 1100X3. Now, from 1 October this year, if you want to rely on the new regulatory relief in new Division 1A, and the plan operates where consideration is payable, like a startup option plan with an exercise price, one of the requirements to get the relief will be that the company will need to give valuation information about what is the market value of the company. And there's a hook in the legislation to saying, okay, well, if you've obtained a valuation in accordance with ESS 2015-1, then you can use that valuation for regulatory purposes. I think it works in the case where there's a startup company that qualifies to use ESS 2015-1, but I think there could be a bit of a gap there, which I think I'm hoping ASIC will look into and perhaps look at fixing, because the issue is if you're an unlisted company and you don't actually qualify to get into ESS 2015-1, can you nonetheless still use a valuation under ESS 2015-1 for regulatory purposes? It's not quite clear, and so this is one of the teething issues that I think will need to be ironed out before the new regulatory environment commences on 1 October. Another interesting issue that I've seen is, will the commissioner sign off on market value? I have seen a ruling from last year, and actually it wasn't in the context of startup tax concessions. It was the context of a tax deferred option plan where the company had raised capital just before COVID at what was then the market value. And then a few months later, after COVID hit, the executives were required to exercise their options because they were otherwise going to lapse. And so they were, in this ruling, what the ruling basically says is the executives are saying, well, hey, we raised capital a few months ago, but there's been this intervening event. Will you accept a lower value based on a market value that we've obtained? And the ATO, in a private ruling, signed off on that. Moving to the next point on this slide, granting startup options to associates of employees. So this is a really interesting issue, I think, because as we all know, the share scheme rules in 83A, they work well, they work fine if an employee nominates an entity to acquire the ESS interest. Now, most commonly, the most desirable entity is a discretionary trust. You wouldn't put your options or shares in a company because companies are ineligible for the CGT 50% discount. So it's usually in a trust. There are different issues with SMSFs, which I won't go into today. So you can, if you're operating a startup plan, you can permit employees to nominate their trust to be granted the options. But there is a catch with that. And it's around the application of the look-back rule for the purposes of the timing of the acquisition of the shares upon exercise of the options. So the default rule, if I was granted options, is that when I exercise the options and acquire shares, there's a special timing acquisition rule that says, okay, well, I am deemed for CGT purposes to acquire those shares on the earlier date when the options were granted. That is very helpful in a startup setting, particularly where exercise is linked with an exit event, and I'm only able to exercise the options shortly before an IPO or a sale event, in which case I may not have a chance to actually hold my shares for more than 12 months. So you say, okay, well, this look back rule is great because it means that I don't need to worry about that. I can exercise my option, and as long as the options were granted more than 12 months ago, I'll still get the discount. But the issue, if options are granted to associates, is that if you look at the look back rule in the section on the screen here and the language in which it's drafted, it basically says it applies to a share the acquirer acquires if it reduces the amount to be included in the acquirer's assessable income. Now, if the trust is the acquirer, then I think there's an issue. I don't think this section would operate to deem the acquirer to deem the trust to have acquired the shares under the look back rule on the date the options were granted. I think there's an issue, and that's because, as we know, the reduction is not to the trust's assessable income. The reduction is to the individual employee's assessable income under 83A 33. So I think it's probably an inadvertent oversight in the legislation and something we might be able to look at getting fixed, but I do think it's an issue. That said, participants might still want their options to be granted to an associate for other, non-tax reasons, for example, like asset protection. So, and the startup rules can still apply. They still apply if options are granted to a trust. So it's not a problem per se, but it could be a little sting in the tail if an employee was hoping to get the discount and the shares are granted to their, or the options were granted to their trust. Now, the next point on here is around cash settlement of startup qualifying options, which I don't think that can be done effectively and resulting in the discount. So the legislative requirement in the section on the screen there is that, and this is the minimum exercise price condition, it talks of the amount that must be paid to exercise the right. So I think it's implicit in the operation of the startup rules that the options, they must have an exercise price. And my view is that exercise price must actually be paid in order to acquire the shares, in order for these concessions to work. So generally in my design of plan rules, I don't include like a typical cash discretion in a startup qualifying plan, or if I do, it's certainly not just an ordinary course of business cash settlement, because I think it would disqualify the participant from getting the CGT discount. Now, I don't think that's contentious, but what is more contentious, I think, is when it comes to actually exercise a startup qualifying option, and we get to a not uncommon position where participants may struggle to fund the exercise price. So the question then is, what can you do? What can you do if the participant can't fund the exercise price? Well, I think that the concession will still work if the plan rules contain cashless exercise mechanisms. So if you can exercise your options, let's say, and then sell a portion of your shares and then use that to fund the exercise price, in other words, in a cashless way, you've still paid the exercise price. I don't think there's a problem with that. I think net settlement is an issue, and it's one I know that is being looked at by the ATO. So net settlement is this idea where you say, well, look, I have an exercise price that I need to pay. My options are in the money, so to speak. And so instead of me paying the exercise price, can't we just take the net amount and you just give me a number of shares equal in value to that net amount? So I think with that net settlement concept, again, I think there's a risk that the participant has not actually paid the exercise price. But I think there's some uncertainty around this, and I think some ATO guidance on this and actually all these issues would be good. Moving along to M&A issues with the startup options. This is also quite a topical area, particularly in the last couple of years. We've seen quite an active tech sector with lots of exits for very high growth tech companies. So I have been in a position as an advisor where I've been approached with a company that is looking to exit, where they've got startup options on foot, and it raises a number of issues, some of which I'll touch on now. The first and obvious issue is around the minimum holding period rule, which, as you all know, says that every acquirer of an option must be prevented of disposing of the option or the share within a 3-year period after the date of grant, unless the person ceases employment or unless they intended to comply and the commissioner allows an earlier time. But one of the issues is that the commissioner's discretion to lift the 3-year holding period is actually very limited. The words of the legislation say that it only applies where all membership interests are disposed of under a scheme. So that's actually very narrow. And I think it's actually narrower than the language in the EM. The language in the EM includes an example of an IPO and suggests that in an IPO, the commissioner would have the power to exercise his discretion. But I mean, in my experience in an IPO, it would rarely satisfy the requirement that all membership interests are disposed of. There might be a partial sell down, but I don't think you could get into that language. I've also seen an example recently where there was a pre-existing 30% shareholder which increased its shareholding to 100%. So it effectively did a takeover, but it already had a 30% interest. And my view in that context was, again, the commissioner wouldn't have the power to lift the 3-year holding period rule because you couldn't say that all membership interests were disposed of in that arrangement. So I think the practicalities of lifting the disposal restriction are quite real, and also what it means is that in the context of a deal, a number of clients in my experience are reluctant to get bogged down in discussions with the ATO lest it interfere with the deal timetable, particularly if there's uncertainty around whether the ATO will actually be able to exercise its discretion. So that then results in a question of, well, what happens if you blow up a startup plan? And I have blown up too, in my experience. And what we mean by this is where you basically say, all right, well, we had the best of intentions to actually comply with the 3-year rule, but there's an M&A deal on the table, and they're not going to, it would be the tail wagging the dog for the company to say, we're not going to complete an M&A transaction because the employees won't get the discount. So what I've seen in that situation is they say, well, look, we'll cash settle the employees, we will blow up the plan, we'll breach the 3-year rule. And what that means, if the 3-year rule is breached and if the startup concessions do not apply, it really requires you to go back to square one again and build up your analysis of what these options were and how they are taxed under 83A, because there'll still be options. They will still be granted to employees in respect of their employment. So 83A will still apply to options, even if the startup plan is blown up. So you have to go back and almost reverse engineer what these options were and how are they treated. Now, interestingly, there won't be the tax deferral language in 83AC in the startup plan. So you'll need to be relying on real risk of forfeiture again to get into tax deferral, which would often be there anyway. So I found that to be quite an interesting process, and ultimately, in my experience, there wasn't too much pushback from employees in that circumstance. Generally, if there's an exit event and employees are receiving a cash payment and it's a liquidity event for them, they're generally quite grateful, and they take the view, well, the plan has done its job. I've had value out of this plan and I'm getting cash. The other issue with startup plans, and where it gets also a bit more difficult in maintaining the integrity of the plan, is where the deal to acquire the startup company it's not just a cash deal, but more often than not, it's actually a cash and scrip deal. So from the shareholders' point of view, they're looking at the transaction and relying on 124M rollover relief for the scrip component of the deal, and they're being taxed on the cash component. And so where this causes tension for participants in a share option plan is also how they are going to fund the exercise price if let's say the cash component of the deal is not sufficient to pay the exercise price. I've seen that come up a couple of times. And again, once you then start having discussions of, well, how can we fund exercise price? Can the company pay a cash bonus? Well, yes, but that's a real cost, and it'll be money out of the pockets of the ordinary shareholders on completion of the deal. So that's generally a non-starter. Can the company make loans to fund the exercise price? Yes, it could do that. But again, complicated, messy, how many employees do you have? It's another moving part in often quite complex deals. So generally that's not desirable either. So, and you equally, companies generally want to look after their employees. And if employees are saying, well, hey, there's a huge exercise price and I can't pay it, well, equally, it'd be a bit cruel to just say, okay, well, if you can't pay the exercise price, your options are just going to lapse on completion of the deal. So with all these moving parts, I have seen decisions made to just say, look, we're going to forego the CGT concessions under the startup plan, and we're just going to cash settle with your consent, and it'll just be taxed as ordinary income. Moving on, and still focusing on the startup tax concession. There's one of the requirements to get into the concession is the 10% maximum ownership rule in 83A 45, 6 and 7. So as a starting point, your founders of your startups will not be able to be granted startup qualifying options because they won't satisfy the 10% test, because most likely they have far more than 10%. But there are often discussions around how to top up founders, because when there are various dilution rounds, or Series A, Series B, the founders' percentages that they can see them shriveling away, and generally they also like some kind of equity incentive to bring them back up or to restore what they had, or to prevent further dilution. So how do you do that? One way that I've seen is to grant indeterminate rights to founders. Now, of course, if a founder has more than 10%, they will be taxed on grant on any ESS interest that they're granted, if that ESS interest is ultimately share settled and not cash settled. So I think, and that's not a bad outcome, by the way, if the share price is expected to materially increase. But I think it means that in order to prevent the immediate crystallization of a tax liability, the rights to founders would need to be indeterminate rights, which means that they must be cash settlable. Now, I've discussed this before with the ATO, and there's no problem per se, but the cash settlement discretion actually needs to be genuine. You can't just say, "Oh, cash settle," but there's no there's with your right hand you're saying, "Nah, actually, we won't consider cash settling." It has to be a genuine right to cash settle, and there also has to be some thought given as to how it would be funded, in my view, to add to the substance of the arrangement. The next issue is who qualifies as an employee for share schemes purposes. This is also a very common issue that comes up, and it's an issue where I'm generally comfortable to take quite a broad approach to this point, because as we know, employees aren't just common law employees, but they're extended to include directors and individuals who provide services to a company. And the ATO has itself adopted a very broad approach to who qualifies as an employee for share scheme purposes. This is one example of a private ruling on the screen there, where the ATO says things like, the relationship does not need to be a direct contractual one. It can be informal. And then the ATO says, if an entity has provided an individual with a share or a right to a share, that of itself is strong evidence of the existence of a relationship between the two. If the provision of the share or right is in any way connected or related to the provision of services by the individual, it is a relationship similar to employment. So it's a very broad test, the way the ATO applies it. And one example where I've seen it applied is if, let's say, there's a startup and it has a services agreement with a third party, and under that services agreement, various employees of the third party are working on projects for the startup. In that case, there's no direct contractual relationship between the startup and those individual employees of the service provider. But I think if the startup chose to grant qualifying startup options to those employees of the service provider, I think these rules would still apply. I think that's all I'll say on that, but that's one area where I think there's quite a lot of flexibility in how grants are structured. Value shifting, I'll just touch on this briefly. The value shifting rules are a regime that seek to prevent inappropriate shifts in value between equity interests in the direct value shifting rules by avoiding transferring shares and triggering what a CGT event A1. So, for example, if you issue shares at a discount, technically those would be up interests under the value shifting rules, and the other ordinary shares would be down interests, and technically the value shifting rules could apply subject to various exemptions. Now, my view is it's entirely inappropriate for the value shifting rules to apply in an employee share scheme context where 83A applies to appropriately tax the employees on the value of their shares. But there is a missing link. There's no legislative protection that says that if 83A applies, value shifting does not apply. And again, I've discussed this with the ATO, and I mean, the ATO agrees. They say, look, there is no inherent legislative protection. So, value shifting is something that needs to be looked at. Now, many times there are a number of outs to value shifting, like the de minimis $150,000 concession exemption will often get you out of value shifting, or if there's no controller for a scheme, which is broadly a 40% interest in a company. But there are still situations for startups where I do look at value shifting, and clients can get a bit nervous about it. And one mechanism that I think does mitigate value shifting is the use of an employee share trust, where shares are issued to the trust at market value under a typical employee share trust arrangement. In that case, where shares are issued for market value, there's no premise there for value shifting to apply. And then, of course, as we know, with share trusts, they can be operated, quite successfully to still operate share plans. And the final point here is with listed companies and startup tax concessions. And the point here is simply that the act of listing a company, it's not the act itself that disqualifies the company to be able to grant startup options. There will still be a window after a company has listed where they can still grant startup qualifying options. The legislative test is that the company can't be listed at the end of the first company's most recent income year before you acquired the interest. So if the company listed in, let's say, January 2022, you could still grant startup options up to and including 30 June 2022. So that's all on the startup tax concessions. Let's now discuss.
So what we might do, Shaun, if I can, we have had 3 questions come through related to startups, so perhaps a good spot for those. So our first question is, if 2 design architecture firms were to merge by forming a new firm, is that likely to be able to meet the definition of startup? One of the original firms is 20 plus years old.
So the answer here based on this question, it looks like the answer is no, because as we know for the startup rules, one of the conditions is that the company in which the shares or options are granted and every other company in that group cannot have been incorporated more than 10 years ago broadly. So if you are merging, if let's say you have one group of companies, let's say a young architecture firm that was set up 5 years ago, and that firm is merging with an old architecture firm that was more than 20 years ago, if all those entities remain in the group, then when you apply the 10-year test, it will be failed, because it's not just the head entity, it's all the entities in the corporate group. I mean, interestingly, if you, let's say you consolidated for income tax purposes and you rationalize the group and let's say reordered your assets into an IP co and an opco, and let's say you had a redundant company in the group and you deregistered that redundant, let's say that redundant old company in the group, then you would be able to apply the tests to qualify. So that's an interesting aspect of the startup rules, is that there's no feature of the rules that says once you are disqualified, you are forever disqualified. The rules apply at the date of grant by reference to a set of facts at the date of grant. So if you got rid of an old company in a group and you look carefully at the timing of the tests, I think you could then get into the startup rules if that was desirable, and also you'd be wanting to look at the aggregated turnover test if you're merging 2 firms, and just remember that it has to be less than $50 million aggregated turnover. And obviously, if you bring the two groups together as a single merged group, then all of their revenue will be aggregated for the purpose of that test.
So the next question is, what is a startup qualifying plan? Can you outline it? So perhaps a brief outline in the interest of time.
Yeah, no worries. I can do that very, very quickly. So a startup qualifying plan is basically one where the various conditions need to be satisfied. Firstly, by the company. Company and its group must have been incorporated less than 10 years ago. The employer must be Australian resident, can't have been listed on a stock exchange. Aggregated turnover has to be less than 50 million. If you tick those boxes, then you're looking good. Then there are rules around the actual grant of the options. They have to qualify for, they have to be subject to the 3-year minimum holding period rule, which we've discussed already. And also the individuals have to satisfy the 10% test, and they have to be employees at the date of grant. And we've discussed today the concept of an employee and that it's really quite a flexible concept. So I think when you tick through those requirements, you get to a point where you say, okay, well, we can operate startup qualifying plan. And really then there's not that much to it, in the sense that it's just a share option plan with a minimum exercise price condition and a 3-year minimum holding period rule. And the ATO still has templates out there, I think, also from around 2015, that will give you a sense of what the startup plan looks like if you don't have one and you want to see what they look like.
Perfect. So the next question, do you know the positive tax regime changes that have come from the 2021 Commonwealth Tax Committee's review of employee ownership?
I don't have those trippingly off the tip of my tongue, but I do have that report printed out. And I think, there is some low-hanging fruit in terms of those recommendations, like fixing the disparity between tax deferral for shares and share rights, where there are different rules that apply, and it's nonsensical. There's no reason why there should be different gateways for tax deferral on shares and share rights. So that's some low-hanging fruit. And I believe there are rumblings out there to begin looking at a model for implementing employee ownership trusts akin to those that are operating quite successfully at the moment in the UK, and which EOA has been quite vocal about in recent times with education and through social media. So I'd say stay tuned, and EOA will no doubt be lobbying for various changes, and also not forgetting about listed companies as well, where they're stuck with a lowly $1,000 tax exempt plan, which particularly with our inflation getting up there is becoming less and less appealing from an incentive and attraction perspective, I think.
Perfect. And then the final question up at the moment is, can Division 83A apply where options are granted by a company to a worker, but the worker is employed by a PEO, labour hire organisation? And is there only a contractual relationship between the company and the PEO, no contractual or employment relationship between the company and the worker?
So I think this is exactly the example that I was discussing earlier, where it would still apply. So if these workers are actually providing services to your company, they needn't be doing that under a formal direct contractual relationship with those workers, for the reasons that I mentioned. And if you look at that private binding ruling reference, I think that'll give you some support for that. Now, obviously, you would want to document it to be clear that the relationship is formed. So you'd want your offer letters and board resolutions to refer to the factual scenario that is in front of you and the reason why, why do you want to grant options to people who are not employees? Like, if the reason is, well, because they're valuable and they're providing services to us, then I mean, that should be documented, I think, to support the position that you can grant them the startup options.
Perfect. I'll throw back to you to keep going.
Okay, so I'm going to speed up a bit. Let's deal with some issues with listed companies. Now, as we know, from 1 July this year, there's no more tax on cessation of employment, which is fantastic. This was best described by our chairman of EOA when he appeared, Andrew Clements, when he appeared before Parliament a few years ago, and he described it in the Hansard when I read it as, this is the rule which is most prone to random acts of gratuitous share schemes violence, which I love that turn of phrase, and it's so true. And it's just great that from 1 July this year, we won't have to deal with it. What I'd like you to ping in the questions to me or in the chat is, well, what are listed companies actually doing about this? Is there actually going, is this, you know, are listed companies now looking at implementing longer performance periods, for example, because they're not burdened by a tax problem when an executive ceases employment? So might they leave executives on the hook for longer to see how their policies and actions played out, because, you know, there's no longer tax on ceasing employment? It'll certainly make M&A a lot easier, for example, with demergers and, you know, moving employee populations. There were often really counterintuitive outcomes that arose with leavers who might still stay in the group, or people who left the group but didn't trigger a taxing point. So all of that complexity, I think, will be dealt with by this change. In relation to demergers, again, I think there'll be a trend, particularly with the stock market having tanked recently. I think there'll be a trend in non-qualifying demergers. So in other words, demergers where your shareholder base has significant cost base, and you might want to structure the demerger in a way that actually wouldn't qualify for demerger rollover relief in Div 125, because you might want to raise capital or do various things which, under the Commissioner's view now, might disentitle you to the exemption. But I think, you know, a non-qualifying demerger is more palatable in an environment where the share prices tanked and you have a large body of shareholders with high cost bases. My only points here are just around the distinction between 5,000 salary sacrifice shares and $1,000 tax exempt shares. Now, with the $5,000 salary sacrifice shares, there's no legislative requirement that the shares be held for any period of time. They're simply taxed when the disposal restrictions lift. So in the context of a demerger, companies could look at lifting the disposal restrictions on the salary sacrifice shares and triggering the 83A taxing point, which also would give the employees cost base in their shares before a demerger, which might be helpful. Now, you can't necessarily lift the restrictions for the $1,000 tax exempt shares though, because the rules say every acquirer is not permitted to dispose. So I'm very nervous around $1,000 tax exempt share plans and making sure that there's no breach, because the way I've interpreted these rules is that if you breach the $1,000 tax exempt share plan for anyone, it actually blows up the plan for everyone, the way these rules are drafted. So, you know, the only way to lift the restrictions is if someone ceases employment, which is still relevant, or if the 3-year period ends. Another point I'll just raise quickly is I've seen in listed companies, there might be a trend to executives donating their LTIP awards to charity. Now, interestingly, this might have been more of a mind shift when the stock market was riding high a few months ago. But I have had occasion to look recently at well, how would an executive of a listed company donate their awards to a deductible gift recipient? And the first two options there, I think, are clearly the easiest. Cash settlement and payment by direction would get you there, although there would be a mismatch because there'd be an obligation to withhold PAYG, so the net amount that can be donated would be less, so there wouldn't be an exact offset. Share settlement and immediate sale would be also, I think, a good one, particularly if there's a plan administrator, and that can be done quickly and easily. In that case, there's no PAYG withholding because there's been share settlement, and so the ESS rules apply. It's all ESS income by self-assessment with a direction to then pay an amount to a DGR. So again, these first two bullet points are around the executive donating cash and claiming a tax deduction. The last two are quite interesting, and I've looked at them as well. Can you salary sacrifice an LTIP award? That's an interesting question, and I'm happy to give you my views on that if anyone is interested. Voluntary forfeiture, again, I think that can work as well, because under the forfeiture rule in 83A, if you allow an award to be cancelled, you're treated as if you never received it. So in both of these last two bullet points here, they would involve the executive in effect giving up their LTIP award, and it would actually be the listed company that would then make the donation to a DGR and claim a tax deduction for the donation. Interestingly enough, the voluntary forfeiture mechanism, you would actually save payroll tax compared to the other options on the screen. Now, with employee share trusts, I've had occasion to look at these issues on the screen here recently. Can employee share trusts hold loan shares under a loan funded plan? The answer is yes. Yes, they can. There's nothing about the eligibility requirement for a trust to be an employee share trust that requires the shares to be actually taxable or dealt with under 83A. But the risk for share trusts holding shares under a loan plan is actually that when it comes to transferring the shares out or dealing with shares and allocating, if 83A does not apply, then the various CGT exemption rules in Div 130 will not protect the trustee against E5 gains, for example. So there certainly are issues to watch out for if your employee share trust is going to volunteer to hold loan shares in the employee share trust. Although I've also seen it operated where loan shares are held on their trust on a separate arrangement, not in an employee share trust. Can ESTs allocate shares to foreign resident participants? Short answer, yes. I'm also aware that the ATO has been looking at issues around contributions to ESTs in the context of large multinational groups with global share plans, and asking the question: are you claiming the right amount of deductions in Australia for contributions to your share trust? Again, that's a big topic, and I'm going to skip along because we just have a few minutes left. The next slide, tax issues with loan plans. Loan plans, I think, are still popular. They're popular in circumstances where you can't access startup tax concessions and you have an unlisted company. Whenever we talk about what is market value, because generally under loan plans shares are acquired at market value, we must always remember there is this rule in 964.10 that says, in working out the market value of a share, disregard anything that would prevent or restrict conversion of the benefit to money. Now, I would say, the obvious application of that rule is to say, well, you can disregard an actual disposal restriction on a share. So if you can't sell a share, then that's something that restricts or converts. That's something that would restrict or prevent the conversion of the share into money. So clearly, you would disregard a disposal restriction. But I am aware there are some private rulings out there where the ATO actually takes quite an expansive view on this. And the ATO's view is that actually you disregard almost everything, including performance conditions, vesting conditions. You disregard them all. My personal view is that I don't think that's right, and I think that is an issue that's ripe for testing in the courts, if anyone is game enough to do that. Fbt issues with loan plans, I think that's a fairly well-trodden path. I won't spend any time discussing that other than to note it. Divestment of shares at less than market value. I mean, this is really, that of itself is quite a big topic. So again, I'm not going to spend time other than to note that it needs to be well thought through. And same with Division 7A. If someone is not a shareholder or an associate of a shareholder of a private company, yes, you can make a loan to them, and Div 7A won't apply to that initial loan. But if someone is a shareholder, then you have to be very careful with making loans to employees, particularly if the share scheme exception does not apply. And the share scheme exception will not apply if the shares are acquired at market value and there's no discount. So you won't be able to rely on that specific exception to Division 7A. Finally, in the 2 minutes remaining, and assuming that no further questions are asked of me, I'll just make a couple of quick points about premium priced option plans. One point and I've been involved in a few of these arrangements with junior ASX listed companies, where the share price is 10 cents or 30 cents. And I think that's really where your premium priced option plan probably has the most value, because if the company is hoping the share price might go to $2, then irrespective of whether the exercise price is 10 cents or 30 cents, the plan still has enormous upside. My point here is that the date of grant is critical, because that's the date when you test whether the option is sufficiently premiumed. Now, I have seen plans where a legally binding grant is made when a participant signs the acceptance form. I don't like that for a premium priced option plan, because if you're sending the letter out to, let's say, 10 employees and they have 2 weeks to sign the form, you might actually have grant dates across a 2-week period. And if you're in a company with a highly volatile 10-cent share price, the movement in the share price across that 2 weeks might actually be material to whether your plan is effective. So if the share price, if the exercise was set and the share price, let's say, went up 30% across that 2-week period, then you might have some options that are not sufficiently premiumed on the date of grant. That's why with premium priced option plans, I generally like a structure where nothing is binding until the company actually grants the options. So you can send out your letters, which are just invitations. Participants sign the invitations and send them back, but the participants don't acquire any legally binding rights until the options are actually granted by the board, which will happen on a singular date. And on that date, the board makes sure that the options are sufficiently premiumed. We are bang on time.
Yep, we are at time. So we didn't have any further questions come through. But Shaun, thank you very much for your time today. And Everyone, a recording of this session will be made available and over the coming weeks up on the EOA website, so definitely check that out. And then finally, a plug for our Tuesday, the 7th of June at 9 a.m. session with Professor Andrew Pendleton. He's going to join us for a look at employee ownership trust and what the attractiveness is for business succession. So definitely look out for that invite, which was in our recent EOA newsletter. But once again, Shaun, thank you very much for your time today, and thank you to everyone who joined us. Have a good rest of your day. Thank you.
Thanks, Michaela.